Hello. Conditions have been more favorable for community bank mergers and acquisitions as we've seen an uptick in the activity. As of September, there have been 121 bank deals announced since the start of the year. But there are still conditions that are causing many banks to stay on the sideline. This panel discussion will look at what final roadblocks must be lifted and what banks looking to buy and sell are concerned about for 2026. Our panelists include an investment banker and two community bankers who have recently completed the M&A process. Learn about related considerations like credit quality, corporate culture, and regulatory oversight, as well as how conditions may differ in 2026. Let's join our sponsor, Ardmore Advisors, and our panelists for Will 2026 be the year the M&A Dam Breaks open?
Thank you, Lori. We would like to welcome everybody to our discussion today. I know myself, I'm very excited to have a great group of panelists today to talk about this very timely topic. I'm going to go around the room here and let everybody introduce themselves. And Chad, do you want to start?
Sure, Todd. Hi, I'm Chad Hull. I'm a managing director and head of depository investment banking at Janney Montgomery Scott.
Thanks, Chad. David?
Hi there. This is David Boyle, or I am David Boyle. I'm the CEO of Burke and Herbert Bank in Alexandria, Virginia.
Thank you, David. And Lori?
Hi, I'm Lori Lobb. I'm the Chief Credit Officer at ACNB Bank, and we are headquartered in Gettysburg, Pennsylvania.
Thanks, Lori. Let's go ahead and get started. Chad, I'm going to start with you. Things have started to pick up in 2025. How would you characterize the current climate of the M&A market in community banks?
Sure, Todd. So the market is definitely improving. We've seen transaction volume increase. Valuations are increasing, albeit modestly. Deal value is up materially. So last quarter was the highest level of deal value we've seen in about 4 years. And we should see the same kind of outcome for the current quarter that we're in, fourth quarter here of 25. In fact, in the month of October alone, we had about 22 transactions that came in at a staggering $21.5 billion of deal value, which was more deal value than the full year 23 and 24 combined. So it's a increasingly active environment, and there are a number of drivers that are creating the momentum in bank M&A. Clearly, the equity markets for banks are up. If you look at the KBW index, it's up about 18% year to date. You had some starts and stops with Liberation Day, but over the course of the year, we've seen improvement in that, which is important as banks tend to use their stock as currency. Interest rates have been helpful. It's making financing cheaper. It's helping support the strength of the industry from a margin standpoint. And it's one of the bigger impacts. It's decreasing fair market value, purchase accounting considerations, which have created a lot of friction on deal activity the last couple of years. We have a pro-growth administration in 25 that is effectively repealed Biden's executive order. So deals are getting approved quicker. And we're seeing bigger deals and we're seeing multiple deals by buyers. Bank balance sheets are strong. Seen some recent cracks in asset quality, but it seems to be generally holding for the industry. And we have a resilient consumer despite some economic concerns with unemployment and the like, but the underpinnings of the economy seem sufficient in building confidence for buyers. And then lastly, Todd, I just say we have a pipeline of sellers who have been sitting on the sidelines for the last couple of years, waiting for the market to improve, that are, faced with often succession issues, whether that's at the board, the management, C-suite, and or the shareholder level. So there's a lot of factors that have been moving that momentum forward here as we kind of close out 25.
Great, thanks. So clearly we're building momentum in 25. Do we see the landscape changing moving into 26?
So you certainly don't have a crystal ball, but as you just look, like the last couple quarters here, as I mentioned, there seems to be a meaningful uptick. We're probably going to clock about 180 transactions for the year, which is up from an all-time career low as long as I've been doing this in 23, where we only had about 100 transactions. And as the industry gets smaller, it's harder to keep those numbers going up. But if you look at the percentage of companies that transact, we're getting back more in the 3 to 4% range, where it had kind of bottomed out at 2. So we seem to have some positive tailwinds here as we move into 26. But there's certainly some risks out there. Certainly geopolitical. We see foreign affairs in Israel, Ukraine, China, and now Argentina, with macroeconomics, with the tariffs, which of course are right now before the Supreme Court. Asset quality has become more of an issue, as there have been some notable potentially isolated issues, but potentially more industry wide. And of course, we have market risk. We have a pretty heated, frothy equity markets, which, while banks have not participated in that as much, some sort of capitulation in that could affect all publicly traded companies. So we're always tweet away, but I from something else happening, but I remain optimistic that we should see this trend continue into 2026.
Fantastic. Yeah, a lot of moving pieces, obviously, but it sounds like we're heading in a direction to sustain, this kind of volume and grow it. I'm going to stay with you for a minute here, Chad. Then I'm going to move on to David. Deal pricing. So valuations year to date 25, and especially for community banks. Do you see this changing, through the end of this year and going into next year?
So, valuations are a little puzzling, right? So, we continue to see bank stocks just generally outperform quarter over quarter. ACMB and Burke and Herbert had really strong third quarters, beat analyst estimates. The stocks, though, haven't necessarily responded to some of this strong operating performance. And so, while while bank stocks are up, so is their book value and earnings, and we haven't seen an expansion in multiples. We've seen a stabilization, and in some cases, contraction. And so, when banks are generally trading historically like at a 12 times earnings, we have plenty that are trading in the 8 to 9 times, and that makes pricing higher multiples to sellers difficult. When bank stocks are trading cheaper, buyers want to preserve their they want to be judicious about it, and not over issue stock to make up for a nominal price that someone might be seeking. So, or else they'll clearly have some economic concerns of dilution on their end. So, it's tough to answer that question in terms of where we're heading on valuation, but it's better than it was the last couple of years, but it's still below historical levels when you look at multiples of earnings, multiples of books.
Thanks, Chad. David, did you have any thoughts on that you wanted to share?
Yeah, I think bank stock valuations, I'd echo a little bit of what Chad said, that a lot of it depends on where you are, number one. So there are differences take where we sit in Northern Virginia across the river from Washington, right? We have challenges in the market relative to real estate and other things. And a lot of us are getting painted with the same brush, that from a valuation perspective, which is a little, I think, I'm a typical CEO who thinks our bank's undervalued, Chad, right? But I think we're being painted with a brush that's a little unfair relative to what's going on in the market. Others in different parts of the country that aren't maybe facing some of the challenges that we're facing here, the trading multiples in some cases are a little bit better. So it makes it tough for us as a potential acquirer to use the currency the way we would like to use it, to make a deal work. And so a lot of deals, they just don't pencil out. It's a math problem. And until we as the undervalued part of the market get recognized for the value we are creating, it's going to be tough. It'll be tough for us to participate in M&A.
Thank you, David.
Yeah, Todd, just to interject, one thing that could change that is we've certainly seen some headline transactions. Huntington has been on a little bit of a warpath. We saw Fifth Third, and the more exposure to these big deals that you see in the Wall Street Journal and other big outlets, you have an opportunity to get generalists involved and take recognition that the industry is so cheap. I mean, relative to Other sectors like technology, it's night and day. And so there is the prospect that there could be some rotation into the space. And if that were to happen, that would be a nice catalyst to help with some of the commentary that Dave just mentioned there in terms of getting some recognition for some of the great results that the community banking sector is experiencing.
Great, great. Thanks for that, Chad. I'm going to move over to strategy a little bit now. So, considerations. Lori, I'm going to start with you on this. What are some of the primary considerations that make M&A an important component of the bank's growth strategy? Challenges in organic growth, opportunity, et cetera. You want to elaborate on that?
Sure. So at ACMB, we maintain a dual strategic approach to growth, both organic and inorganic, because we believe growth isn't optional. It's essential for our long term success and independence. Organic growth is our top priority. It's the foundation of who we are as a community bank, building those relationships, deepening trust, and finding those solutions that help our customers succeed. That's the everyday work that sustains consistent performance for us. Our markets typically grow 2 to 4% a year, and we set a similar expectation for organic expansion within that range. We then supplement organic growth with inorganic opportunities where it makes strategic sense. So, over the past decade, we've completed 3 whole bank acquisitions, each with institutions that were geographically aligned, culturally compatible, and financially strong. Those partnerships have allowed us to expand our reach while maintaining the community focus that defines who we really are. As a result, we've tripled the size of the bank over the last 10 years, increased our shareholder dividend by 90%, and doubled our share price. In our view, that performance has earned us the right to independence, and we intend to preserve it by continuing to execute on this balanced, dual-pronged growth strategy.
Great, thank you. Well, thank you, Lori.
Sure.
David, similar situation. You've Burke has been active in M&A, acquiring over the last decade. Thoughts on the topic to share?
Yeah, I think I would agree that organic is the most. It's the best for the shareholder. The more organic growth you can put on your balance sheet, that's really what drives the best value for the shareholders. Our strategy includes a focus on what markets do we want to be in, and in those markets, if there's an acquisition opportunity, that's great. We would certainly welcome that and take a look at it. But generally, what we're finding is that the organic strategy, while it takes a little bit longer, it ultimately it proves out to be better. And so that's where our focus is market-based growth, expanding our footprint contiguously to where we sit today. And then again, if there's an acquisition opportunity with the right cultural fit that is shareholder friendly, that we think we can really drive value from, we'll certainly take a look at that. Our goal at Burke and Herbert Bank is to be a top quartile performing company through the cycle. So if we look at an acquisition opportunity or a strategic partnership, with whatever that may look like, it has to have a clear path to maintaining that top quartile performance. And so if it doesn't, then we will politely step aside and let someone else take that opportunity. So we're very focused on that. But as Lori said, growth is important. The revenue growth, holding on to, keeping your costs as controlled as you possibly can to continue to add value for the shareholders is our focus. And again, we think right now the best way to do that is organically, but would be opportunistic where appropriate.
Great insight. Great insight. Thank you, David. So, for several years now, there's been a reasonable amount of economic uncertainty, and the interest rate environment has been a little bit uncertain. So, Chad, I'm going to go back to you on this topic. How have these factors, both the economy and uncertainty there, in interest rates, how are those affecting deal activity and/or, I guess, valuations at the moment?
Sure, Todd. So yeah, look, we went through 15 months of 525 basis points up, and now we're making our way back down. The lower interest rate environment, both on the short and the long end of the curve, I think is a catalyst or to some of the M&A that we're experiencing for a couple reasons. One is, certainly the cost of capital as rates come down is helpful for those that are looking to finance acquisitions. But the other, I think, more important part is the fair market value friction that has really challenged deal making the last couple years. So when rates skyrocketed, the value of bank loan portfolios, investment portfolios were underwater. That made combining companies challenging because the buyer had to mark that to market and recognize it. And so came out of the chute with a lower capital level. As time has marched on and durations have shortened, and the 10-year tends to trade now at a reasonably attractive spot relative to where it was during much of the last couple of years, that has lessened that blow. And so the friction again is ebbing and makes some of the deal math much more palatable as as we have moved through 2025. General economy, economic conditions. Like I said, we've seems like the banks are trucking along. There have been some notable hiccups with some credit. Not sure it's all economic driven. Some of that was fraud driven. The consumer seems to be getting a little stressed here, but they prove resilient. So I think that the pathway though still remains favorable for M&A, and I think that's why we're seeing the uptick that we've seen.
Great. Thanks, Chad. So, changing gears here a little bit, there's a lot of things that can contribute to a successful or an unsuccessful merger, and to an extent, due diligence is only going to get you so far, and some of these problems don't come to light for some time. So, David, I want to ask you this question: what are some of the biggest obstacles for that would lead to a successful bank merger today, or an unsuccessful bank merger, I guess?
Yeah, I think well right now for us it's valuation, but we'll pass on that part of the discussion. But um, number one for I think for us is culture. The cultural alignment. If you've got a cultural alignment with a partner, um, and you're open and honest and candid with each other about the things that are working well and the things that aren't working well, go into these thoughts with or these potential transactions with the idea of no surprises. Let's just be open and honest with each other. The valuation is a math problem. It'll figure itself out. What we focus on is what are the things that could actually derail a project or an acquisition somewhere down the road. And in our most recent merger of equals that we did, we had a long session between the two management teams talking about what's working, what's not working, what are the best practices of the two companies, how do we go forward, what system, what people, what having that open, honest, candid dialogue. And regardless of what jersey you're wearing, whether it's a Burke Herbert jersey in our case or a Summit jersey, it didn't matter because we're coming together as one company. And let's look at that and put our biases toward our individual companies aside and really move forward as one. I think that's probably the best mindset to get your folks uh, thinking about after you've agreed to come together. In advance of coming together, the due diligence is really important. But again, it comes down to that cultural alignment that you can see through due diligence and through conversations and management meetings and as most of us know, these things don't just happen overnight. We know each other as CEOs. We know each other's banks pretty well as CEOs. The industry engagement that we have through the various trade organizations is really important that we get to know each other that way. Um, that those are probably what I would say. No surprises is probably my number one. Culture and no surprises. Those are the things that they can really put you in a bad spot. And so fortunately we didn't have any of those. We had some hiccups, of course, but we didn't have any surprises we didn't expect in ours.
Great. I'm going to stay with this topic, but I'm going to move back to Chad on this one particular question as it pertains to regulatory. Regulatory headwinds, are those impacting right now timing and I guess strategy to an extent of these deals closing? Are you seeing any of that in the marketplace?
Just the opposite, Todd. I mean, really, the regulatory headwinds these days are few and far between in M&A deal making. Deals are getting from announcement to closing are averaging around 120 days. I saw so really an expedited process relative to the environment that we were coming out of under the prior administration. Is I mentioned the executive order that was a sort of a hard look at M&A across all sectors, but banking in particular, really created a lot of uh, slowdown, or created a big slowdown in merger acquisition review. Deals were getting extended. We saw deals get out there about a year, some get out there 2 years, and that's just no way to try and pull off an M&A transaction. You've got capital at risk, you've got people's careers and their livelihoods and all that kind of in the wind. And we've seen in today's environment a total 180 from that. So deals are getting greenlit, and the other aspect of that is when you did a deal prior to the current year, in the last say few years during the last prior administration, that was your deal. You were going to do one, and you were going to kind of integrate. You were going to prove that you were successful in integration, get sort of the regulatory green light before you could go out and seek another transaction. Now we're seeing deals get announced right on the heels of deals closed. Huntington bought Veritex for $2 billion down in Texas, and a week later announced their transaction with Cadence for $7.5 billion. That would be unheard of in the prior administration. So we are seeing again just the opposite. We're not seeing necessarily an encouragement, but really an acceptance and a path forward for getting deals efficiently reviewed and having banks moving on from start to finish.
Thank you. Thanks, Chad. Lori, I'm going to come back to you on, David spoke a little bit about this with the success of integrating during mergers. And as you mentioned, you've been involved in three over the last decade. So can you give us a couple examples on, challenges that you faced, really more on the integration side? So after, the banks are together now, so how are you integrating that and
Yeah.
challenges?
Yeah. So we've learned the hard way. So we know that even the best strategic fit can fall short if the integration isn't executed thoughtfully. So for us, the biggest challenges have been, and the most important lessons that we've learned have centered around people, culture, and the big one, communication. So every acquisition we've done, we know they come with talented teams who have their own processes, systems, and way of doing business. The challenge is how to blend that without losing the strengths that made each organization successful in the first place. You can integrate the systems fairly quickly, but integrating the culture, it takes time and consistent communication. We have found that early engagement, transparency, and involving both legacy teams in the planning and decision making, it really goes a long way toward building that trust. And you need that trust. So, aligning the policies, procedures, especially around credit compliance and operations, it's complex. And we manage that through structured processes where we define clear ownership, milestones, and accountability. The goal is to move quickly enough to maintain momentum, but not so fast that we create confusion or fatigue. So, and finally, again, I go back to communication cannot be overstated. Both internally and externally, it's critical to be clear, consistent, and visible. Whether it's with employees, customers, regulators, people want to know what's changing, what's staying the same, and more importantly, how it's going to impact them. So at the end of the day, successful integration is less about the transaction itself, and it's more about the execution. Staying disciplined, transparent, and focused on people first, that's what turns a good acquisition into a lasting success in our view.
Great insight, Lori. Thank you. So one of the largest components of the balance sheet is the loan portfolio, obviously. So, we've been in a pretty strong credit cycle now. Things have, here and there, cracked a little bit, but for the most part, it's been pretty strong. So how can banks, and Lori, I'm going to ask you this question first. How can banks ensure that the credit mark going in to the transaction is appropriate? And are there any potential adverse impacts that are either from the economy or other things that you should be focusing on?
Huh. Todd, that's a great
Kind of a loaded
question.
question.
It really is. It's a great question. And it's one we spend a lot of time on because, as you said, the loan portfolio is critical. It's judgment driven, and it's a big part of any acquisition. So, after such a long, strong credit cycle, it's critical that that mark reflects not just today's performance, but how it might hold up if conditions turn. So here we take a very disciplined approach, starting with the detailed loan level analysis of borrower performance, collateral coverage, and structure. Then we stress test those results under a range of scenarios. That that helps us gauge where losses could emerge if the environment weakens. We also, and this is key, we also engage third parties to help with both the loan review as well as the validation of the assumptions and the methodology. Those independent views help to take the bias out of the process and ensures that that mark is defendable. Ultimately, the goal is to strike the right balance, conservative enough that the mark holds up in a downturn, but fair enough to both institutions. It's about setting the combined bank up to move forward from a position of strength. That's how we do it.
Great. Great. Thank you. Chad, I'm going to ask you a follow up on that. So we talk about the loan portfolio and arriving at the credit market, things like that, and risks there. Are you seeing emerging risks outside of that due diligence team should be paying a lot of attention to or closer attention to in the current environment?
Todd, I think the quick answer is we'll all know in hindsight, right? So, as we sit here, it's we're not. I can't give you anything really empirical or anecdotal that we're seeing different. I mean, I think diligence is done pretty smartly and a lot differently than it had been. Pre Great Recession, a lot of advisors, a lot of folks involved in the process, and so the diligence process tends to be pretty deep and thorough. But again, there's always something that'll be pretty obvious down the road. Um, so I'm not sure that's 100%. I can't put my finger on anything that I think is an emerging trend per se. But one risk I would say is that when banks are doing multiple transactions, like we're seeing now, and again, it's not an overwhelming number of institutions, but we're starting to see that the sometimes the integration aspects get left behind as they move on to the next transaction, and so the expectations that were driven from the due diligence and from the sort of deal thesis of the initial transaction never get uh, proven out because they're moving on to the next then, and that's where problems can come to roost. So that'd be one thing I'd kind of keep my eye on as we move forward with particularly with those that are engaged in multiple transactions.
Well, I'm going to keep you on the hot seat here for one more question, just to follow up on that. What about mistakes? Are you seeing, what are some mistakes that due diligence teams could be making in the process, either during negotiations or in the due diligence process itself, that community banks particularly should be paying attention to?
Yeah, I always think like the best way to approach transaction is to be prepared. And we often see at times that when banks, say strike a deal, so to speak, between the principals, that sometimes they get ahead of themselves and get off to the races, and they start, for instance, exchanging information. They haven't really vetted it or thought it through. It could be stale and lack kind of the current directional view on their business. Simple things like minutes not being redacted. Amazing some of the things that get past the other side. Commentary about the other bank, about the other bids and things of that nature. So it's really important, we think, and it's self-serving, but to get professionals involved that can help process that and be a check around that. Exchange, for instance. And then also, again, it's at times some of the use your advisors to sort of message and help negotiate various aspects of the transactions. You know, particularly as it comes around to people, we see sometimes some pretty complex issues develop around employment agreements with 280G and 49A issues, and deals are struck and then have to be unwound because they're going to create an economic disincentive or hardship, and that could be a personal issue, and you really want to be mindful and careful about not breaking down trust amongst parties. So, again, another reason to support bringing in your advisory team earlier to help with that. And then lastly, I guess what I'd say is, a risk that exists out there, and maybe one that should be a little bit further developed in the current market, is that often I'd say that sellers don't do enough due diligence on the buyer. So if they're taking stock, if it's a stock exchange, they're basically making an investment in that buyer. And if it's a bigger bank that is, well read by the analyst community, SEC reporting, and lots of information around it, sometimes they can take that for granted. But they owe it to themselves and they owe it to their constituents to not just wing it. That they really do need to make sure that they're making a good long-term decision here, because as we talked about earlier, it's not all about valuations these days. The premium isn't always day one. It's over time in many of these cases that you're building the premium through greater combined operations of the two institutions. So getting a good insight into the strategic direction and performance of that company, I think is time well spent on the seller side before just focusing on your what you're getting out of the transaction.
I'm going to stay with due diligence for one more follow-up question. I'm going to go to you, Lori, on this one. How should acquiring banks be evaluating technology, fintech partnerships, digital banking capabilities, things like that at the targets? Any thoughts on that?
So it's evaluating technology and digital capabilities. That's become a core part for us of the merger due diligence process. It's not just about what systems a bank is using, but it's also about how those systems support the customer experience, operational efficiency, and their overall risk management. We look closely at compatibility of some of those systems, like can their core systems and digital platforms work well with ours, or maybe even replace ours. Sometimes an institution has a better or more creative tool, and in those cases, we may look to move forward with their solutions if they're scalable and align with our architecture. One thing we do pay close attention to: vendor and fintech contracts are a major focus. We review them very carefully, looking at the renewal dates, termination clauses, data ownership, and pricing structures. The goal is to avoid inheriting long term agreements that are costly and limit flexibility or duplicate services after the merger. In many cases, that early review creates opportunities to consolidate vendors or renegotiate stronger terms under the combined organization. At the end of the day, it's about balance. We want to capture the innovation and efficiency that technology can bring, but within a framework that aligns with our risk standards and enhances the overall customer experience.
Thank you, Lori. Let's move on to some metrics to consider in the process. And David, I'm going to start with you on this. What are the most important metrics, key performance indicators, and such buyers should be analyzing during the process?
Yeah, I think, Todd, that depends a little bit on why you're doing the merger or the acquisition, right? I think if it's an in-market consolidation of a competitor, that might be one set of things to think about. If it's market expansion, it could be another. If it's a true strategic merger of equals, there may be some other considerations. But in a straightforward acquisition, for us, I think you have to set some thresholds on what a couple of these KPIs are. You need to talk with your board and understand what their tolerance is for both dilution, return expectations for the legacy shareholders of your bank that are going to be allowing you through their vote to take the risk to make an acquisition. And then what are your shareholders going to say to you? What do you think about? And the best way to understand that is just talk to them. We frequently talk with our institutional investors, and they quiz us frequently, almost every conversation about our M&A appetite. And we turn the table on them a little bit and say, okay, what is fair to you? What do you think is a fair EPS accretion amount, first year in, or a dilution or an earn back? How long does it take you to earn back any tangible book value dilution? And so for us, we've set some minimum thresholds on EPS accretion for each of the three different types of transactions. We have set an earn back expectation. And, most, Chad, you might chime in on this a little bit. Most investors like to see that at 3 years or less on an earn back. There are reasons to go beyond that, and you just have to be prepared to explain, if you're going to pay something more than that, why you did it and why you believe that's the right thing for the shareholders. So those are the few that I would look at early on, and I caution everybody to be careful about um, some of the modeling expectations that you do use, because they drive these metrics and can move them pretty dramatically. Uh, Big one for us is we focus a lot on cost saves. What is a realistic cost save? And it's not just the cost you're going to take out of the acquired organization. There may be some cost saves in your own organization that you can affect, but there's also, depending on where you are in the asset size threshold, there are some expenses that you're going to incur as part of growing, that you really have to net that out of the expected cost saves of a transaction, because you're going to have to make some investments. That's hard for a seller to understand sometimes, but if you're looking at it for the 24 and 36-month return, what is the expected return for this deal in 2 or 3 years, as opposed to day one premium? I think those are some of the considerations I would have people think about. At least that's our view of it.
Lori, anything to add on that?
So we're very similar. So I'll go at it from a credit perspective. So, from a credit perspective, the metrics that we focus on are the ones that truly reflect the underlying health and resilience of the portfolio, not just the headline numbers. We start with the basic, debt service coverage ratios, loan to values, whatever, risk rating distributions. Those give us an initial read on the credit quality and underwriting discipline. We think that's really important. But what's even more important is the trend behind those numbers. Are coverage ratios holding steady as rates rise? Have loan to values crept up with market appreciation? Are we seeing migration in risk ratings that signal softening performance? That movement over time tells us a much clearer story than a static snapshot ever could. We also look closely at portfolio concentrations by industry, collateral type, geography, because that's where exposure can quietly accumulate. In today's environment, with certain sectors under more pressure, understanding where those concentrations sit is really critical. And then finally, we try to analyze credit migration, how that portfolio has shifted among past special mention and classified categories. A portfolio that's stable through different cycles says a lot about an institution's credit culture and how proactively they've managed emerging risk.
Great, Lori. Thank you so much for that. So we've talked about scope. We've talked about focus and due diligence. We just talked about key performance indicators. Chad, I'm going to go back to you. Are you seeing any are buyers being more selective in the current market in terms of geography or asset quality or business model, anything like that? And any particular barriers you're seeing right now for deals getting done? So we haven't.
Sure. Well, I think buyers are always selective around asset quality in general. But as the last couple of years have shown us, deposits are the natural resources of this industry, right? And the preference for the low cost, granular, sticky deposits, lower loan deposit ratio institution has been one of the more attractive targets, so to speak, for buyers for for the last couple of years. Fortunately, a lot of those come with a lot of misplaced investments that create the AOCI, which makes those transactions at times difficult. But at the end of the day, the deposit uh, side of the balance sheet, I think are really a differentiator for a lot of of banks, and buyers tend to find those with those attributes, more obviously more attractive. Though we are seeing a little bit of migration, banks are also trying to, clearly jumpstart the lending growth. We've seen, some of the national players take, big acquisitions into new, perhaps more growth oriented markets. I mentioned already that the transaction down in with Huntington down in Texas. Texas right now seems like everybody wants to be down there from an M&A perspective. Korea PNC went out and bought market share in Colorado. So it's a combination of both, as we see it here today from an M&A perspective.
Great. Thank you. David, I'm going to go back to you. So we've talked numerous times today. There are a lot of things to consider in any acquisition. What are your top three priorities? I mean, you're looking at a lot of, I'm sure there's deals that come through that you don't pursue. There's some that you take a quick calculation to, and some you take the full due diligence. So what are your top three priorities, I guess, when you're evaluating a potential target?
Well, we start, as I said before, we start with a cultural fit first, because if the cultures don't align, that's going to make everything problematic. And so that's number one for us. The second is the market. We need to make sure that we're focused on an acquisition in markets that we want to be in, number one. Number two, we think our business model will do well in. We would never model increased growth for a market, but we do think about, if our business model is accepted the way we expect it to be, what is the real upside in doing a transaction in a certain market? And probably third would be the valuation, right? We want to make sure that when you have a focus the way we do, it being a top quartile performing company, we don't want to do anything through an acquisition that's going to move us out of that top quartile. We think we earn our independence every day, and we believe if we're in the top quartile of performing banks in our peer group, that our shareholders will reward us with our independence and not put pressure on us to do something we wouldn't necessarily otherwise consider today. So valuation for our existing shareholders, and then also the consideration you're giving to the other shareholders. And some companies have shareholders that are okay shareholders. Some company or shareholders have shareholders that you may not want as shareholders. And so you have to think about and think through what that combined universe is going to look like, and how are you going to manage your way through a potential problem or a potential challenging situation with somebody. So I would say those are the top three for us today. But again, a strategic merger might be a different set of considerations than just a in market scale type acquisition that you're just trying to bolt on and get 50% cost saves and just move on to the next thing. So each one's going to be a little different.
Great. So strategic alignment is the top priority.
Top priority is strategic and cultural alignment for sure.
Great. Lori, let's go back to you on the next question. And this might getting a little more technical, maybe on the credit side. So what are some of the most challenging things that you've encountered or you've been challenged to overcome in integrating credit cultures? Because while you want to strive to, you're looking at targets with similar credit cultures, they're not always going to be perfect, and you're going to have challenges along the way. So how are you integrating those credit cultures post merger? Maybe, the target that you're acquiring is a little more liberal. Talk a little bit about that.
Yeah, sure. So we believe the most challenging part of integrating credit culture after the merger is alignment. Making sure both organizations share the same philosophy around risk, structure, and decision making. Every bank develops its own rhythm, judgment over time. So even when the policies, and we look at them, the policies look the same on paper, but in application and practice, sometimes they're really different. So what has really helped us is taking the time to really listen and understand how each team approaches credit, not just jumping in and saying, look, this is the way you're going to do it now. So it's hard, you want to, but we work to blend the best of both cultures by identifying where practices align and where they differ. And then we build consistency through discussion, training, and clear communication. It's also important to model that consistency from the top down. When approval officers and committee members demonstrate disciplined, balanced decision making, it really helps the entire team understand expectation and builds trust in the new structure. Ultimately, it's about respect and communication, acknowledging that both organizations bring certain strengths to the table and using that as a foundation to build one cohesive, disciplined credit culture.
So, taking this a step further, moving into maybe again something a little more technical, because there is a transitionary period of risk that exists. So, talking a little bit about approvals from a post-close standpoint, um, how how are you managing that? And what are some risks that exist in that transitionary period where you're operating as separate institutions, and maybe the system integration hasn't occurred yet? How are you dealing with that?
So, even if the system integration hasn't occurred, we try to go right under one combined organization. So, our focus immediately shifts to maintaining consistency and control through our established risk management practices. Even though the systems and processes are being integrated, we don't change the fundamentals of how we evaluate and approve credit. That continuity, we believe, is key. We continue using our formal approval structure right from day one. So every loan renewal or loan approval goes through the same disciplined review it did before the merger. That includes credit analysis, adherence to policy, and documentation standards that ensure nothing slips through during the transition. At the same time, we identify and prioritize higher risk relationships or those with upcoming maturities for early review. We want to get ahead of those potential renewals, covenant triggers, or borrower challenges so we can make more proactive decisions and not reactive decisions. We also know that a strong monitoring process is critical during the transition. We stay very close to the data. We track renewals, exceptions, and approval activity in real time. We ensure that there are touch points and regular reporting that help us to identify delays and inconsistencies before they become issues. That proactive approach keeps the process moving smoothly and helps maintain stability throughout the transition. Ultimately, the goal is stability and consistency. Integration takes time, but by keeping our risk framework and credit culture intact, we manage through the transition without compromising credit quality or customer service.
Thank you so much, Lori. That's great insight on that. Um, so we've talked about obviously a lot of things today, and I'm going to ask my final question to David. And this is I'd really appreciate your input on this. At some point, it's going to be somebody's first time going through an acquisition. It's going to be a CEO's first acquisition. You've been through a lot of them. What's one piece of advice that you can give to somebody that would be going through this for the first time?
As a buyer or a seller, Todd?
As a buyer.
Okay. Okay. Uh-huh. As a buyer, I would say there's a couple things I might say to this. The first is don't be in a hurry. Um, Make sure that the conversations you're having with your counterparty are open and honest, and just open the kimono, let it go, and make sure that you have a clear understanding on both parts. Number one, I like Chad's thought about getting your advisors in early. I think that's really, really important. Um, I would also say if you're going to be a first time acquirer, make sure your team is ready. And when I say that, it's not just your accounting and finance team to do the nuts and bolts of accounting, which is near and dear to my heart, but it's your operations team, your credit team. It's all of that. Make sure they're ready to think through how they would do something like this. And then the final piece, and I don't want to say it's less important today than it was maybe a year ago. If you're doing this for the first time, make sure that your board and your regulators are on the same page with you about whether or not you're ready. Those are things that can get in your way, if you will. But if you're having those conversations, proactively primarily with your regulators, that they know that this may be coming. They can and likely will give you some confidential feedback about certain things if you've got that good relationship with them. So uh, if you're starting out for the first time, those are a couple things I'd encourage you to think about.
Thank you, David. Thank you for that insight. I really want to thank you guys today. This was a great panel, a discussion, a lot of information, a lot of good insight, and I really appreciate you taking the time out of your day to share the questions with us. And that concludes our presentation for today. And again, I just want to thank you guys for being part of it.
Thanks for having me.